Hi everyone, it's Ipta Insights here with another review. It's a review for Boom 500 for a move that transpired between the 26th and the 27th of February, which is the day of this recording. So, without wasting any time, let's get into it. Let's get into the price action. All right, so we had a naked chart, and just to save time, I've already put in the key levels or the lipstick for that particular move. So right there, let's dive into it. We have our lipstick. So before focusing on our price action, we had what? We had price targeting this liquidity pool in a form of what? Sell stops residing where? On this relative equal loss or retail support. So price trades through it, closes below the liquidity pool, that's displacement. We are bound to see what? Lower prices. If it closes above the liquidity pool, rejecting it, then we see what? A retracement or a reversal of the trend. So I hope nothing is confusing there. We've taught that countless times on the beta program. And then price, we are bearish, right? Due to this displacement of this liquidity pool. So price forms what? An up close candle. If we form up close candles and we are in a sell program, then they should offer what? Resistance. Every up close candle should offer a selling opportunity. That is what it means. All right, then. Right here we have our bearish order block. We find the main threshold of that bearish order block. It's up to you if you want to use the body or you want to use the wicks to measure. Right, here's our main threshold. To measure the mean threshold, it's very subjective. I'm much comfortable with using the bodies, right? So there's no right, there's no wrong in that regard. You can use the weeks from that week's high to the week's low. You'd have your main threshold right here, which is the 50% of that order block. All right, so order block is validated right here when we trade below its low. This candlestick trades below it, it validates it, and then we see this candlestick digging into it right here. It's a selling opportunity to target what? This old low. It rejects the liquidity pool, which would have been what? It would have been our old low. That was our target, right? After trading into this bearish order block. I'm just taking you through this whole price rally so you can have a better understanding. All right, it trades through that. So we're going to have what? A reversal or a retracement. We see what? A reversal, which is a run on opposing liquidity. We run buy side liquidity, tap into the what? The main threshold of our order block. So this becomes the new liquidity pool for sell side. And this becomes what? The new liquidity pool, that high becomes the new liquidity pool for buy side. But what is this high doing? It's reacting on the main threshold of our order block. So we are bound to do what? Keep on attacking this. We trade into that area, attack what? We attack, sorry about that. We attack our sell side right here. So this becomes the new sell side liquidity pool. All right. Already I've annotated it, so no need for me to draw it out. So right here we have price doing what? There's our sell side liquidity pool, old low or a swing low. Price does what? Fails to reach our liquidity pool right here. So our buy side liquidity pool is still intact, and we have this main threshold level for this bearish order block on the daily, right? So if that happens, then price rallies back to into what? It rallies back into our main threshold. It was bound to either trade through this high or through this equal relative equal low highs rather, and into this into what? Into this fair value gap, which is a CB, but it failed to rally across the main threshold of our order block. So that means what? That's a failed swing. If it's a failed swing, it's going to attack the other side of the liquidity. It failed to attack buy side here on the swing high and respected the main threshold of our order block. That's what we want to see for algorithmic price delivery. And eventually we form what? Eventually we form trade lower, fail to take out that liquidity pool again. It's forming what? 1, 2, 3 touches on the lows. That's sell side liquidity being engineered in a form of retail support. Equal lows or double tops or triple touches or whatever retail traders subscribe to are going to suffer the wrath of the algorithm on this particular key level. All right, so we see price doing what? After making this failed swing here, it retraces. There's what? There's a retracement and attacks what? This red line here. Pay attention to it. This red line here is the equal bodies, right? The equal bodies that are harboring what? Institutional buy stops. They're harboring institutional liquidity because the bodies communicate what? The bodies communicate the true volume of price, and the wicks, that's manipulation, and what? And the retail stop losses, which is the retail buy side liquidity right here, and other uninformed institutions. So there's our form of what? It's our form of buy side liquidity. So we jump right through it right here on the swing high. We're failing to go all the way to that swing high, right? To take out buy side liquidity. Instead, we run through the what? The bodies. If we run through the bodies, there's the market indicating that it's very weak. It's very weak and it's heavily bearish. We'll trade lower again, once again, after attempting to rally to the upside. And we had already made this swing low, right? We opened here, made a swing low, failed to take out this liquidity pool. We're still engineering what? Sell side liquidity. If we engineer sell side liquidity like this, the algorithm is going to look for a certain fingerprint and price to attack this relative equal lows, right? So we failed to rally to that swing high. Instead, jam through the equal bodies right here, institutional liquidity. If you don't have an understanding on that, then that's unfortunate. Can jam into the mentorship. It's there. Right. So right here we have what? We have what we call a rejection block. This rejected this level here. It becomes, for me, the closing price rather becomes our rejection block right here. So stretch that out on time. And right here we have what? Right here we have this failing to take out this liquidity pool for the 1, 2, 3, 4, 5 for the fifth time, right? So it's a strong level of support for retail traders. And for an IPTA trader, you're looking at that and you're thinking, that's my pool of liquidity. Why? We are bearish, right? We are bearish. We are supporting the bearish idea with this up close candle holding price from going any further high, right? So if we're bearish, we're yet to displace any swing high. We are yet to do none of that. So that's how we would have read our price action. And right here we have our rejection block on the daily. It's very much annotated right here on the closing price of this up close candle. Why is this a rejection block? It failed to rally to that swing high for buy side liquidity, this swing high right here. So it instead ran through the equal bodies right here, which is institutional buy side liquidity. So great. If we have that, then we can go to the 1 hour, which is our bellwether time frame. That's the most comfortable time frame to trade. And we said we are focusing on the move that transpired between the 26th and the 27th, which is today, for this particular move. And here's a rule for the algorithm. If you are bearish, the only time you see price rallying is either it's going up to take out a short-term high or to fill in a CB, which is a fair value gap, which is an inefficiency. So it's either it runs back higher to do what? To take out a short-term high, which is this short-term high. We have a rejection block right here, right? On the 1 hour, we are seeing price doing what? Ramming through this short-term high. So let me just annotate that so we have an understanding on that regard. Right here, we have it right there. That's our stop rate on this short-term high, right? So we see price doing what? Trading through that short-term high. We are bound to see what? An expansion lower. It has already engineered a lot of sell-side liquidity in a form of retail support, right? So this happening when? On the 26th. We said the move occurred on the 26th and the 27th. 27th is when we reached our terminus. All right, so when this candlestick right here closes above that old high, this candlestick becomes a higher probability order block. it is not always a high probability order block just because it has a fair value gap on its side, as people are being taught. There's more to it. This becomes a high probability order block because it's taking out liquidity. The moment we trade right through it, the moment we trade right through the law of this, let me just zoom into it. The moment we trade through the law of this particular move, right? We trade through it. We want to see what? We want to see the same thing that has been happening on the daily time frame, which is price reacting on a bearish order block. So right here, let me just mark out my 1 hour bearish order block. Why am I using that order block in the midst of all these up close candles? This is the last up close candle taking out what? Buy side liquidity. That particular part, that very part of it taking out buy side liquidity makes it a high probability order block. A very high probability order block. Let me just mark it out differently. I would like to use let me use orange. Right, that's our 1 hour order block. Very short block. Right, and price is jamming into a what? The daily rejection block right here. This black line here is the daily rejection block. And what's the narrative on the 1 hour time frame? We are making what? A very short block. So you could have been a buyer right here when price traded right through this order blocks law and came back into it. You could have bought there, but that is very risky for those who are not comfortable with that entry technique. And further, we see what? A buy, a sell rather, a sell on a retracement to this bearish order block. You want to sell on a return to order block. We taught this in the previous classes. You would have had that as your position, stop loss wet at that swing high. Why? Because it has already taken out buy side. There's no need for price to go back any further. So you would have a 12 pips stop for a target of 50 pips roughly. But here's the thing: if we are taking a liquidity pool, before I go on to the next entry technique that we would have had, here's the interesting part. Using the swing projections from the swing low to the high that's retesting what? The high that's retesting this order block, we mark out our swing projections right there, the standard deviation for where is the potential target in case this keeps on trading lower than this liquidity pool, right? So we have the underlying level just below this liquidity pool is this 2.5 level, standard deviation 2.5. That would have been your target right there. And you stretch it to the next target. It should have been what? Standard deviation 3 extension, which is right here. If you don't have an understanding of this, it's there in the mentorship. You know, there's a lot of exciting stuff in the mentorship. Put in a very great combo of interesting concepts. So there's a lot more to learn. So if you was trading this, you can see how it gets to our level here, right here, trades away from it, then that could have been your last TP right here or right there, whatever you're comfortable with. All right, let's get the standard deviations out of the way. Right, so let's go to the 15-minute time frame. The entry technique. We are bearish, right? We already marked out the 1 hour order block right there. Price is returning to the 1 hour order block. That's very much fine. So it's up to you if whether you would have traded this move. But look at something here. What did I say about, let me just get rid of this 1 hour order block and leave this part intact. The last time the team taught on advanced market structure, you cannot escape that. You cannot escape it. We have a swing high, rebalancing an imbalance. It becomes what? An intermediate term high. So this is our intermediate term high. That intermediate term high is a rally that is retesting what? The 1 hour order block. 1 hour bearish order block. The 1 hour bearish order block is right here. This 4 consecutive candles. 15 minutes, 15 minutes, 15 minutes, form a 1 hour order block right there. So you'd have had what? Intermediate term high right there. It's not meant to be broken by price on retracements. So right here, we want to engage on price after, right? After it breaks an intermediate term low. And right here, we had an intermediate term low right there. Let me just, I don't know if this will be clear. This intermediate term low is rebalancing this whole imbalance here as low. It doesn't need to refill it completely. It just needs to reprice to this BC. So once we break that area, where's my entry technique? I'm looking for a CB that has been formed. We see what? We are breaking a bullish fair value gap with a bearish fair value gap. That's the easiest way of explaining it. So we have a CB right here, stop loss right there. You're trying to do what? You're trying to sell on the retracement. But look, there's against the slippage, right? It's against the spikes, trading against the spikes. So you do not have to put in a limit order. You just have to watch it as it spikes back into your CBs, and that's it. You know, that's it. That's how you get in. You would have traded all the way to that level. You put in your high right there and slam it lower. Now, there's a lot of concept that I would actually touch here, but let's see another entry right there. So we see price trading away from that area, getting back into what? Getting back into our 1 hour bearish order block. We have an intermediate term high. It should not be broken by any further retracements if we are truly bearish up until we reach our draw on liquidity, which is this liquidity pool. All right, great. So right here we have what? We have price trading higher, takes out this relative equal swing highs. And in the midst of all this, what is price doing? We are waiting up on price to do what? To break an intermediate term. The same thing we did here. We're waiting up on price to break an intermediate term low before we engage with price. So right here, we see it. This intermediate term low is broken by that candle with a what? With a CB. It was rebalancing this BC, this fair value gap, bullish fair value gap, broken by a bearish fair value gap. That's your entry. Your entry is right there. Now, here's an interesting thing. There's a wide stop, right? So you'd use this. Here's the entry rather. You would use, there's a very wide stop. It's not a trade that I would actually trade, but you'd use this as your pyramiding level, putting in more positions into the positions that you'd have thrown in on this level. But right on this level here, why did this intermediate term high form and stop exactly where it stopped here? Why didn't it trade back to this all the way to this 15 minutes bearish order block? Here's an interesting perspective to it. We have a swing high, a swing low, and a swing high. We have a high, a low, and a higher high. This forms what? A breakout block. Stretch that out on time. You can use your breakout blocks as your means of entry. This last down close candle before we break this swing high is your breakout block. So you could have used that as your entry when price comes back into that area. You're trusting that it will not break the high of the breakup block. So that's a relatively lower exposure to risk in terms of stop losses, right? The risk is 6 pips as compared to the one that we was annotating just about now. All right. So those are the possible opportunities that you'd have had, and I hope you take a lot of gold from these teachings. And with breakup blocks, rejection blocks, and all that, that will be the next class. I would like to believe the next teaching on the next session, which is on Wednesday. So stay put for that. Don't be having so many questions. And yeah, in terms of entries, that would be that. Now, we had a question about how would you determine your what? Your exit. Now, pay attention to it. why would you not want to, let me just get rid of these levels, right? And go back to the 1 hour. I think it's much clearer. All right, why would you not want to exit your position when we tap into this liquidity pool right here? We are saying smart money is going to look to run through that area, but how far can they go? So you are not expected to do it. You're not expected to close your positions here. You are expected to take partials in your position. So what you're paying attention to right here is how far can price go? How further low can price go from this area, away from this area? There was a teaching that was being distributed about how smart money likes to sweep 10 pips below a liquidity pool to reach out for any pending stops, right? So there's 10 pips. I was just using this tool because I don't want to go back to the measuring tool. It will take a long time. So it would have been 10 pips. If you're comfortable with that, then you can use it. But I gave you an answer to that already. With what? Swing projections. This right here. From this low, right? To that swing high. Standard deviation 2.5. It's below what? Below this level. It reaches it. Standard deviation 3 is right there. And another thing you want to pay attention to is whole numbers, right? Whole numbers like the 32, 50, 100 level, which is right here. I'd like to leave. I'm not going to be able to annotate them properly, but we have what? The standard deviation levels, right? We had 3260. It's a whole number. And then on the level 3, we had what? 3250. It's a whole number. And towards right here, we had 3240. Let's see if we reached 3240. I don't think so. Okay. All right. Well, nonetheless, I'm just giving you an idea on how you can anticipate exits. You want to exit at the opposing liquidity pool, but in this case, you don't want to close your whole positions right on this liquidity pool, right? Because the market is going to look to sweep this level of support and take out everybody who's trying to buy at this level. And why are we using whole numbers? We're using whole numbers. Why? Because institutions make their transactions on big numbers, right? They use whole numbers to transact. They buy at whole numbers, sell at whole numbers. So they would want to take off that positions at whole numbers too. So you can incorporate that with the swing projections and you would have that. And I think with that being said, I'm not going to go into the 5 minutes time frame. It's not really ideal. But for those who are comfortable with that, they can go into it. I think we've given you more than enough on this move. And yeah, I think that's basically that on that regard. Nothing more, nothing less. So yeah, thanks for listening.